How's everybody doing? My name is William Douglas. I've prepared a presentation for you for forecasted one-year Treasury rates over the next 10 years. I collected data from November the 4th to November the 8th from the Wall Street Journal website. Overview of the week: the yield curve steepens, mainly driven by Fed talks of tapering from the $85 billion in funds they purchase each month. And as you can see from this yield curve throughout the week, terms mid-term to long-term consistently rise over the week. You can also see it with the interest rates. The interest rate forecast is always synonymous with the yield curve. Three-factor inputs to the rising over the week is Fed tapering, unemployment, more people are working, the economy is doing better, and suffering gold prices. Suffering gold always means a better economy. Investors typically flock to gold whenever the economy is in crisis or at risk of inflation. On Tuesday, the yield curve steepened at the 10-year rate. 10-year treasuries dropped 4 basis points. The delay of tapering was the reason for this drop, and that in turn made a high demand for 10-year treasuries. The supply decreased because people were buying more of them. This is the yield curve for Monday. As you can see, the 10-year rate dropped right there on the graph, you can see. And it's more evident on the interest rate forecast. You can see the major plummet in the 10-year rate, as you can see why more people bought these lower rate notes. On Wednesday, the U.S. Treasury announced that they're going to release a new Treasury on January 29, 2014. This is going to be a floating note Treasury, and is the first new Treasury that they've released in 17 years. The Federal Reserve declared that they're going to keep interest rates low as they've promised, and dovish views on short-term interest rates actually brought the medium-term rates back up. As you can see in this yield curve, this Tuesday and Wednesday yield curve, the rates from Tuesday, as you can see, are angling back down, and the Wednesday rates are bouncing back up, and it's more evident to see on the interest rate forecast. You see that huge dip from Tuesday is now bouncing back with the Wednesday, mostly at the 10-year range. On Thursday, the euro was down 0.6% against the dollar. This made U.S. dollar-denominated commodities rise, and the yield curve slightly decreased. Interest rates also decreased as well. On the yield curve, you can see how the Thursday rates dropped a little bit lower than they were on Wednesday, more evident towards the long term. On Friday, the 10-year treasuries jumped the most since they have in July. Major loss for home builders and possible homeowners. Basically anyone with a long position suffered on Friday. Yield curve steepened all the way across, and interest rates were higher for short-term, long-term, and medium-term treasuries. You can see the big jump on the yield curve. Kind of stays close on short term, but from the medium term to the long term, you can start to see that big gap between Thursday and Friday. And the same thing with the interest rate forecast, which is completely synonymous, that gap between the interest rates from Thursday to Friday. In conclusion, the yield curve is going to continue to steepen, which will cause interest rates to rise. The market seems to be compensating for the future already due to the fact that interest rates are rising, even though the Federal Reserve has not begun tapering. Thank you.